The oil market is changing in response to the lower price of oil and the new fundamentals. So what are the critical changes and which companies can survive and thrive in a lower price environment? Today, we take a deep dive. And joining me in this deep dive is Thomas George, Portfolio Manager of the TD Energy and Resource Funds. Welcome, Thomas.
Thank you.
So what are the critical changes you see in the oil market?
Yeah, so we've seen some, over the last 2 months, we've seen some critical changes, and they've really been around global demand, and not just for oil, across all commodities. This has just been a global growth scare. That's, I think, front and foremost the critical issue. In addition to that, we've also had the potential lifting of the Iranian embargo on oil exports, so that also is weighing on the oil market in particular. But at the core of it, we think this is a demand scare globally, and when we think of demand across the commodity complex, there's one big gorilla at the table, and that's China. So
okay. So is it just a scare?
Well, where the market is trying to snuff it out right now. Yes. So ultimately, the data we've seen thus far globally, and I'm going to speak to oil in particular because the other commodities have been weak, and there's been demand weakness around those as well, is demand for oil has been very robust year to date. It's been robust in China, it's been robust in India, it's been robust in America. And the question is, has this spillover from the Chinese equity market, has that impacted consumers? Potentially, we're going to find out. The truth is, the numbers, we haven't seen the numbers to bear it out in completion yet. So ultimately, what we've seen is phenomenal demand growth trends year to date. The market is, as soon as the market snuffs out global demand fears, sell everything, go away, and come back when you think you figured it out. Our view is much more pragmatic. Our view is very much based on fundamentals and where we think the long-term pricing of oil should be, and we think that is driven by the marginal cost of supply, which is somewhere in the range of $75 to $90 per barrel. So when we see oil with a number that's sub $50 per barrel, we think that's extremely good value for investors that have a long time horizon.
Now, what about Iran?
So Iran is an interesting issue where effectively, there's been an agreement. There's potential 800,000 to 1 million barrels coming on the market. The question is, when does that come on the market? There's a lot of question marks here. What I would say is that the volume, it looks like that volume is most likely going to come out in 2016, and we believe that that's a much better time frame for that volume to come on, because if you think about how much demand growth is pegged in the market for 2015, we're looking at 1.5 million barrels per day of growth in 2015 alone. If in 2016, if that volume comes on in 2016 and we get similar sorts of growth, that's going to be absorbed by future growth. So future growth and demand. So in my perspective, there's an element of a stabilization there that if that comes on in 2016, it can probably be absorbed. But needless to say, the market just sold it off and say, hey, Iran's coming back, we'll sell it all. And I would say, when there's this much pessimism in the market, those that can kind of put their hand up and say, I believe in the fundamentals long term of how oil should work, and you've got to use these opportunities if you think there's value.
Mm-hmm. So what changes are you not really concerned about?
Yeah, so those are the two changes that we should be concerned about. Iranian barrels coming on, that's, I would
probably already priced in.
Yeah, already priced in. I would say that's a smaller concern in the sense that, the market knew this was coming back at some point, right? Demand is much more concerning, and we're going to find out, where that all stands. In my personal view, China is the juggernaut here. China is rebalancing growth. It's away from kind of infrastructure, export, manufacturing orientated to much more consumer consumption. So if you think where oil should ultimately fall, I think it's that consumer consumption camp. So we think we're in the right commodity there. So those two are the concerning ones that we think that should work out for oil, because it has better fundamentals, at least on the demand side. Now, the other parts that the market is, specifically the media and market participants get all worked up about, is inventory levels, and they specifically look at U.S. inventory levels. We think, yes, that's concerning for a particular market, the U.S. market, but you really got to look globally. And if you look globally and look at the data, inventory levels are basically at average levels they've been over the last 10 years. So from my perspective, there's basically 55 days of inventory. That's kind of at an average level it's been at in 2000. So it's actually we have less days of inventory than we did back in 2003. So to put that into perspective, so the world's not in a glut at a global level. And then so I put that inventory thing to the side, and then everyone's like, oh, well, watch the rig count on Friday. Right, the rig count's fallen nearly 60%. Unless some sort of miraculous resurrection happens, rig counts dribbling along the bottom aren't as concerning as a rig count spiking back up 20-30%. So in our view, those two are manageable until we see something different. We remain that those aren't big issues. And ultimately, the way we think about it is, a low oil price does two things. It encourages consumption, which we've seen globally. It's been very robust. And secondarily, a low oil price actually disincentivizes people to put capital in the ground, which is what you need as well.
And we've seen both of those with a number of companies.
Absolutely.
Is this how they're adapting?
Well, they've got to, right? If you have a lot of debt,
yeah.
if your barrels don't make money, shut her all down, because it's not going to make sense. Just put it away.
Okay.
And those are the companies we don't want to invest in, right?
Yeah.
We don't want those highly leveraged companies that that are marginally making profit. We want to invest in companies that have low levels of leverage, high levels of profitability, and are investing through the cycle.
So let's look at examples.
Yeah, so two examples for us are EOG and Canadian Natural Resources. So both those companies we think really typify good, well-managed oil companies. And the way we look at it, really, I'll just kind of do the tick box thing. What you really want is a company that has phenomenal resources. Both those companies tick that box. Secondarily, you want companies that are incredibly well managed and managed towards return on invested capital. So any capital they put in the ground, we want to make sure that they're getting a solid, good return for that. Both those companies really manage towards that. And finally, we're really looking at companies that think over the long term, management teams that are prudent. So we're looking for management teams that are willing to say, yeah, we'll pull capital away. If this is not the right time to be investing, you've got to taper back your CapEx plans. And both those companies really understand that. A barrel of oil they produce, they want to get a return for that barrel that meets their capital, that meets their cost of capital.
Now, do you worry about them being potential takeover targets?
Well, potentially. Now, all companies are open, and specifically when you've got really big, I would call it sleepy, integrated oil and gas companies like any of the super majors. These companies can't grow if their life depended on it.
That's the way they do it.
That's the way they do it. They've always done, and if you're going to go shopping, you don't go shopping when oil's at 110. You go shopping when oil's at sub 50. So, we think there's a lot of things that are set up right. We've always advocated stay in the quality companies.
All right. Thank you very much, Thomas.
Thank you.
I've been joined by Thomas George, Portfolio Manager of the TD Energy and Resource Funds. I'm MaryAnn. Thanks for watching.